Everyone loves a good comeback story, and these 13 Dividend Aristocrats might just be next in line. They've stumbled, fallen out of favor, but they still raise their dividends year after year. Each of these stocks has hit some bumps, slowing growth, margin pressure, or just plain bad sentiment. But that means they're all sporting better than average yields, and they have the potential to bounce higher. This isn't just about chasing hype. I identified these stocks based on valuation and future return potential. So stick around to see which 13 names made the list, and the dividend yields only get better as we move through the countdown. The first aristocrat on the list is PPG Industries from the materials sector, ticker symbol PPG. The stock currently sports a dividend yield of 2.3%, but its average dividend yield during the last 5 years was only 1.86%, indicating the stock may be potentially 19% undervalued today. Following an optimistic bounce shortly after the 2020 pandemic, PPG climbed faster than its dividend, pushing the stock into the overvalued zone. In early 2022, the valuation came back down to earth, following a large decline in the early part of the year. Since then, the stock has mainly moved sideways, ultimately feeling more downward pressure in 2024 that has extended into 2025. This brought the valuation to a level not seen since the pandemic. Meanwhile, PPG has continued to increase its dividend at a rate of about 5 to 7% per year, which has pushed its yield comfortably above 2%. Looking at the long-term return potential, PPG clocks in at 10.55% per year over the next 3 to 5 years. This return estimate is the combination of the 2.3% forward dividend yield, a 3.6% annual return to fair value factor, and a 6.2% earnings growth forecast with a margin of safety. There is a link in the description below where you can download the same valuation report for all 69 current Dividend Aristocrats. Moving on to Aristocrat number 2, which is Becton Dickinson and Company from the healthcare sector, ticker symbol BDX. The stock sports a slightly higher yield of 2.37%, and it looks potentially 35% undervalued compared to its trailing 5-year yield of 1.52%. The company has experienced sluggish growth during the last 7 years, and more recently in 2025, the stock has taken a couple of legs down, bringing it to one of the cheapest valuations in its history. This downward pressure on the stock has propelled the dividend yield north of 2%, a level not seen since 2012. Despite this sluggishness, long-term shareholders have been rewarded with an increasing dividend growth rate. Between 2018 and 2020, the company increased its dividend at a rate of 2 to 3%. But since 2021, the dividend increases have improved to between 4 and 5%. Looking at the long-term return potential, Becton Dickinson is projected to return 13.56% per year over the next 3 to 5 years. This is a combination of the 2.3% starting dividend yield, a healthy 6.3% annual return to fair value factor, and a 6.51% long-term earnings growth forecast with a margin of safety. Dividend Aristocrat number 3 is McCormick Company from the consumer staples sector, ticker symbol MKC. The stock pays a forward dividend yield of 2.49% and appears to be potentially 24% undervalued compared to its trailing 5-year average yield of 1.9%. The stock has struggled since early 2022, following a 30% decline. In 2023, it dropped by roughly 30% again, but has seen a marginal recovery in 2024. That being said, it is still a ways off from its natural trajectory, implying there is potential for the stock to continue climbing higher. Despite the sluggishness, McCormick has continued to increase its dividend payouts, averaging a 6 to 8% long-term CAGR. Looking at the return potential, McCormick clocks in at a nice 12.04% per year over the next 3 to 5 years. This return estimate is comprised of a 2.49% forward yield, a 4.38% annual return to fair value factor, and a 6.89% long-term earnings growth forecast with a margin of safety. Dividend Aristocrat number 4 is NextEra Energy from the utilities sector, ticker symbol NEE. Our first aristocrat today with a dividend yield above 3%, 3.08% to be exact. The stock appears to be about 20% undervalued compared to its trailing dividend yield of 2.46%. NextEra had 2 rough years in 2022 and 2023, followed by a nice recovery in 2024. Some of those gains have been given back here in 2025, but the stock is still pretty far from its long-term valuation. In the dividend growth department, the company is not disappointed, delivering double-digit increases every year since 2016. Looking at the return potential, NextEra is projected to grow at 13.06% per year over the next 3 to 5 years. The return estimate is a combination of the 3.08% forward yield, a 3.73% return to fair value factor, and an 8.33% long-term earnings growth forecast with a margin of safety. Dividend Aristocrat number 5 is Brown-Forman Corporation from the consumer staples sector, ticker symbol BF.B. The company offers a forward dividend yield of 3.21% and appears to be about 55% undervalued as compared to its trailing dividend yield of just 1.44%. The last 5 years have been rough for Brown-Forman. Fortunately enough, the company sells a product that is often sought out when things aren't going well in your life. Since late 2020, the stock has declined by a whopping 60 to 70%, with the bulk of this freefall occurring after mid-2023. However, Brown-Forman has continued to increase its dividend year after year, providing anywhere from 3.5% to 8% dividend growth per year since 2020. Naturally, a growing dividend and a declining share price has pushed the dividend yield higher. Between 2018 and mid-2024, Brown-Forman was a sub-2% yielding stock. In the middle of 2024, it cracked the 2% yield threshold, and more recently, in 2025, it has climbed above 3%. If we take a look at the future return potential, the expected return stands at 12.85% per year over the next 3 to 5 years. This is a combination of the 3.21% forward yield, a high 9.18% return to fair value factor, and a very modest 0.61% earnings growth forecast with a margin of safety. This turnaround story, if it becomes one, is heavily dependent on the return to fair value. I don't know any better than the next person whether Brown-Forman can recover to its brief post-pandemic high. But based on its valuation, it at least deserves another look. Dividend Aristocrat number 6 is Genuine Parts Company from the consumer discretionary sector, ticker symbol GPC. The stock sports a 3.29% forward yield and appears to be about 16% undervalued compared to its trailing yield of 2.76%. The stock peaked back in late 2022, moving against the trend of the broad equity market that was not having a great year. But as most equities rallied in 2023 and 2024, Genuine Parts Company declined in value. Since late 2024, the share price has held steady, barring the marginal dip on Liberation Day. To sum it up, the stock got ahead of its fair value in 2021 and 2022. 2023 was a reset year, and more recently, the stock has taken a leg down from its fair price point. Dividend growth has remained modest during the past decade, with increases coming in at about 5% per year on average. Looking at the future return potential, Genuine Parts Company sits just shy of a 10% ROR, 9.71% to be exact. That return is made up of the 3.29% forward yield, a 3.01% return to fair value factor, and a 4.55% earnings growth forecast with a margin of safety. Dividend Aristocrat number 7 is Hormel from the consumer staples sector, ticker symbol HRL. The stock sports a forward yield of 3.71% and appears to be about 26% undervalued compared to its trailing yield of 2.72%. Hormel has been a slow grower during the last 7 years, and that growth in share price peaked in early 2022. As the stock market rallied in 2023 and 2024, delivering back-to-back 20% returns, Hormel's share price moved in the opposite direction. 2025 has been mostly a flat year for the stock thus far. In the dividend growth department, Hormel has slowed increases considerably starting in 2021. Between 2014 and 2020, the dividend rate was raised by more than 10% each year. Since 2021, the increases clocked in around 5 to 6%, and in the prior year, investors saw a sub-3% dividend bump. The estimated future return stands at a very attractive 15.08%. This return estimate is a combination of the 3.71% forward dividend yield, a 4.87% return to fair value factor, and an 8.68% earnings growth forecast with a margin of safety. Dividend Aristocrat number 8 is Clorox from the consumer staples sector, ticker symbol CLX. Clorox has a forward dividend yield of 3.87%, and it's the last sub-4% yielding stock on the list today. It appears to be about 22% undervalued as compared to its trailing yield of a flat 3%. Much as the entire stock market was crashing during the 2020 pandemic, Clorox enjoyed strong returns, but those gains were short-lived with the share price peaking in mid-2020. The latter part of the year was a marginal reset, followed by another leg down in 2021 and a handful more dips in more recent years. 2025 has not been kind for shareholders as well, with the stock declining quite heavily throughout the year. The dividend growth rate for Clorox has cooled off as well, with the last 2 years only seeing increases below 2%, well below the company's long-term CAGR of around 5%. If we take a look at the potential future return estimate, it currently stands at 11.72%. That estimate is made up of a 3.87% forward yield, a 4.15% return to fair value factor, and a 4.93% earnings growth forecast with a margin of safety. Dividend Aristocrat number 9 is Pepsi, also from the consumer staples sector, ticker symbol PEP. Pepsi currently sports a forward dividend yield of 4.23% and appears to be nearly 30% undervalued compared to its trailing yield of 2.98%. Pepsi has actually trended along its dividend yield theory valuation quite nicely between 2018 and 2023. Since 2024, and more so this year, the price has deviated from its implied fair value, in turn presenting investors with a possibly attractive entry point. Pepsi has not disappointed in the dividend growth department by stepping up its increases in recent years. Following 3 years of 5 to 6% bumps between 2020 and 2022, Pepsi followed up with a nice 9.28% increase in 2023 and a 7.79% increase last year. Just for context, these are year-over-year increases and not the actual increase announcements from the company. The future return potential also stands at a nice 11.62% for the next 3 to 5 years. This is a combination of the 4.23% forward yield, a 5.31% return to fair value factor, and a 2.77% earnings growth forecast with a margin of safety. Dividend Aristocrat number 10 is Target, again from the consumer staples sector, ticker symbol TGT. Target currently offers a 4.45% forward dividend yield and appears to be about 42% undervalued compared to its trailing yield of 2.57%. Following its monster post-pandemic rally that saw the share price more than double, the stock has come back down to reality and quite quickly. In 2022, the stock came crashing back down to its fair valuation based on dividend yield theory. However, it has continued to struggle in 2023 and 2024, being left behind other equities that enjoyed robust returns. 2025 has not started out great either, with the stock declining quite heavily, even dipping to 2020 pandemic level prices. Target has a mixed dividend history, with shareholders enjoying brief periods of above-average increases. The latest great period was between 2021 and 2023, with each year seeing at least a double-digit dividend bump. 2022 saw the highest increase from the company during the last decade at a whopping 25.32%. However, last year, Target only raised its dividend by 1.83%, and 2025 is not looking to be much better. The forward return estimate looks attractive at 10.59%. However, it's largely based on the return to fair value factor. The components of the return estimate are the 4.45% forward dividend yield, a 7.31% return to fair value factor, and a negative 1.56% earnings growth forecast with a margin of safety. Dividend Aristocrat number 11 is Stanley Black Decker from the industrial sector, ticker symbol SWK. The stock sports a 4.5% forward yield and appears to be about 33% undervalued as compared to its trailing yield of 2.99%. Stanley Black Decker declined heavily during the 2020 pandemic and spent the bulk of the latter part of the year coming back to equilibrium. In 2021, it briefly pushed higher, but finished the year with only a marginal gain. The trouble for this stock started right out of the gate in 2022. The stock declined by over 60%, bringing its share price down to pandemic-level lows. Since then, it's mostly been a sideways journey for the share price, with some more recent downward pressure in 2025. Dividend growth has cooled off as well, with the last 2 years seeing increases just north of 1%, well below the company's long-term growth rate of about 4%. However, Stanley Black Decker sports one of the best return estimates out of all the Dividend Aristocrats at 23.35%, and this estimate is largely driven by future earnings projections. Looking at all of the components, we have a 4.5% forward yield, a 5.96% return to fair value factor, and a 17.19% earnings growth projection with a margin of safety. Dividend Aristocrat number 12 is Eversource Energy from the utilities sector, ticker symbol ES. The stock offers a 4.62% forward yield and appears to be about 20% undervalued compared to its trailing yield of 3.66%. Between 2018 and 2022, the stock trended nicely along its dividend yield theory fair price, barring some volatility during the pandemic. However, since 2023, the stock has been left in the dust by the broad equity market, and it has deviated from its fair value range. Much of the decline occurred in 2023, and the past year and a half have been a sideways journey with only marginal gains. Taking a look at the dividend growth story, Eversource Energy has been very consistent, increasing its dividend by about 5 to 6% each year for the last decade. Naturally, the consistent dividend growth, coupled with a declining share price, have elevated the yield to levels not seen during the past 7 years. Since about mid-2023, the yield has pushed north of 4%, and it has been slowly creeping higher as the share price continues to be stagnant. The company has a decent return estimate of 12.39%, made up of a 4.62% forward yield, a 3.87% return to fair value factor, and a 5.2% earnings growth projection with a margin of safety. And the final dividend aristocrat on the list today is none other than Realty Income from the real estate sector, ticker symbol O. The stock sports a very nice 5.67% forward yield and appears to be about 13% undervalued compared to its trailing yield of 4.94%. Unlike all of the other aristocrats we looked at today, Realty Income never recovered from the 2020 pandemic. The stock declined quite heavily during the pandemic lows. This was followed by a recovery that extended through late 2022. But the share price never climbed back above pre-pandemic highs. In 2023, we saw the share price marginally decline, and it has remained rather flat ever since. Realty Income has increased its dividend very consistently, maintaining a long-term CAGR of about 3%. It is also the only monthly dividend-paying aristocrat on our list today, and one that increases its dividend every quarter. The stock has always paid an attractive yield, but for the past 2 years or so, investors had the opportunity to lock in a historically high 6% plus yield. Today that yield is a bit lower, as the price has appreciated a bit more recently. Realty Income also sports a very nice forward return estimate of 20.87%. This estimate is made up of the 5.67% forward yield, a 2.45% return to fair value factor, and a 16.99% earnings growth projection with a margin of safety. There you have it, 13 dividend aristocrats with potential upside and potential comeback stories. If you'd like to see how the other 56 aristocrats are valued right now and their return estimates, you can download this full report using a link provided in the description below. I don't know whether any of these aristocrats will recover and go on to generate robust returns in the years to come. The goal was to give you a few ideas to investigate further. And that is the intention of why I track and value all of the aristocrats, to identify potential opportunities, keyword being potential. If you found this content insightful and you'd like to see more from me, check out my newsletter, Quality at a Fair Price. I share many of my ideas there each week. Also, please leave a like and subscribe to the channel. Thank you for watching and see you next time.